All right, good evening, guys. Ken at Tortoise Capital Foundation's Q&A check-in for February 22nd, 2024. A lot of questions to cover, so we'll just jump right into it. Jonathan asked, earlier this week, we had a trade that I called on the nightly podcast, a 1-2-3 entry, which was different than my understanding of that entry. See below, this is a Alcoa from, I think, Tuesday. This was the opening. It sold off. And then my entry is right around in here as it's crossing the VWAP. And thought a 1-2-3 meant you had a clear low followed by a second candle that made a higher low. And then you would enter on the high of the third candle when it passed the second candle's high, provided that it did not make a new low or a low below the second candle. So when we see, yeah, that's correct. And this is what happens. This is a 30-minute chart. I'm trading that one on a 3-minute chart. The entry that I get on the 3-minute chart is a 1-2-3. It's very close to a 1-2-3 here. Like the 1-2-3 would have actually been right about there instead of right there, because that's in the second bar. But you are correct. The 1-2-3 is simply, it has a swing low, and then it closes anywhere, and then it opens anywhere. And when that bar closes, it has made a higher high than this previous bar, and it has made a higher low. When the second bar in that sequence closes, and only when it closes, can you say definitively, that's bar two, because you don't know that it's bar two until it closes, and then you can check to see if it made a higher low and a higher high. Like you will know if it made a higher high already. When that bar closes and it's a bar two, retroactively we can say that is bar one, and now this thing opens somewhere. As long as it does not, now if it's an intraday, it should open right where it closed. But if this was a swing, there might have been a gap. So we're mindful of that. But what we want to see is it opens inside the real body of that candle. And then and then while it is live, it makes a new high above the high of bar two without making a low below the low of bar two. So that's a live candle. And as soon as that breaks out, then we enter it. And then typically the price that invalidates that 1-2-3 move is a violation of the swing low. So at its most primitive level, that's exactly what that is. It's all a 1-2-3 entry is 1-2-3, higher lows, higher highs, and when that third candle takes that one out, it's gone. Now, on the 30-minute bar, this thing was close to a 1-2-3. On a 3-minute bar, that's a 1-2-3. Where I'm stalking that thing is this was all part of a kata 2 formation. On the 3 minutes, it had been up in this area and had sold off, came up here, made a higher low on the 3 minutes. The R10 crosses the 30. The PSAR has flipped. I'm approaching the combination of the Bollinger Band mean and the VWAP. This is a 1-2-3 entry right in here. And that's the trade that I'm making, and I get out here. When you translate that over to the 30-minute bar, what I end up getting is, because I have 1, 2, 3, 4, almost 4 are in hand. I converted this one to a swing trade by selling 80% of it here and keeping 20%. And then the actual exit on this other bar happened about 45 minutes later over here, and it was a lower low than this first sell-off. So the swing trade on 30 minutes is this trade. The intraday trade with a tighter stop exits 80% there at about 3.5 R. The entry reason to get in is a 1, 2, 3 on 3 minutes. It was close to an entry, a 1, 2, 3 entry on the 30-minute bar. The key point was that on the 3-minute, it was a kata 2 and winter turned to spring and it crossed the dragon and it's testing the Bollinger Band mean and the VWAP. So that is all reason to give it that much risk. And the risk I take just goes right back to the original VWAP, which is from 26.37 to 26.27, which is a 10-cent stop, which is a lot tighter than the stop on a 30-minute bar.
So you'll use the 1, 2, 3. You can use it superimposed on other patterns to kind of confirm your early entry on the kata 2, or maybe on the SSC to get in before it's crossing the dragon. You'll see that 1, 2, 3 at some point after it bounces the bottom. You say I can get in before the PSR flips or before it crosses the dragon. This is sort of my sign.
Exactly. One of the things that I notice is that when you have on an early move, when you have a gap down to here and then a harsh sell-off, that bar came all the way down here, and now I'm noticing I'm getting these higher lows all the way up the stack. So when it's crossing the VWAP, I'm ready to go, and I'm stalking this thing from right in here over on the 3 minutes, and I see that little kata 2 action and the PSAR flipped here on the 3 minute. Like on the 30 minute, the PSAR doesn't even flip until 1, 2, 3, 4, 5, 6 bars later, which is 6 times 30 minutes. This entry here, the PSAR doesn't flip for another 3 hours. Whereas on the 3 minute bar, it flipped 30 or 40 minutes ago from the time I entered. So when I enter here, on the 3 minute, the PSAR had flipped right about there. But this one is close to a 1, 2, 3, even on the 30-minute bar. I would have had to wait another 30 minutes for the 1, 2, 3 to fully form. And you know where that's going to form? Here's the high of the previous 30-minute bar. I would have had to wait until this breakout to get in on the 30-minute bar. And as you can see, that's almost 2 R away. So the price improvement that alerts me are these rising lows off the bottom. And the fact that it is getting ready to come back to the VWAP. In fact, the thing that's really interesting to me is that the VWAP, which had been up here the day before, and that comes down to here because of that gap down, and then the VWAP is leveling off right here. But the price sold off all the way down here and then gives me these bars. And I'm getting higher lows, and it's just getting to the VWAP. So the fact that the lows are rising tells me, hey, go look at the 3 minute and fine tune your entry. And then I can see, oh, here's the low. Here's that next low. That low and then this low are part of this series of 30-minute rising lows. And it gives me a kata 2 and the VWAP. Now the VWAP is the same. That's one of the beauties of the VWAP is it doesn't matter intraday what time candle you're looking at or what time of a bar chart you're looking at. The VWAP is always the VWAP because it's every purchase of every number of shares at that weight at that price. So it always prints at the same location. So when it's crossing the VWAP here, it's crossing the VWAP there. The PSAR flips are different. The Bollinger Band means are different. Like this one is based on 3-minute bars times 30 minutes. So the Bollinger Band mean on that one is constituted by the last 90 minutes of price action. But on this one, because I'm using 30-minute bars, it's 900 minutes of price action has created the Bollinger Band mean. And guess what you can't even see on this chart? You can't see the Bollinger Band mean because it's way up here because this thing gapped down so far. But on the 3-minute bar, so one of the things you learn on the 30-minute is harsh sell-off and rising lows, and I'm 90 minutes into the day. That had 3 bars to fail further, and it didn't. So now I can actually take a standard risk box off the low, and now all of those signs point to yes. And then I can go to the 3-minute and fine tune it, and I look at all kinds of reasons to buy it. It's a risk box off the PSAR flip. The dragon was here and is here, so the dragon's making a double bottom. The Bollinger Band and the VWAP are right there. And then if it gets through this, that's going to be free and clear. That's the relief of great tension. Why? Because it had power to get through this resistance. It couldn't get through that resistance level. It failed. But it made a higher low. So that's telling you that the buyers are coming in at a higher price level and picking up the slack. That means when they go test this, there's a better chance that it breaks through because the buyers are more aggressive here than they were over here. So when you put all those little factoids together, I see a 1, 2, 3 entry there, and I'm in. But there's 3 or 4 different ideas for entry coming in at that point. On the 30-minute bar, when I'm talking about that, it's a 1, 2, 3 entry because I remember why I got in. And you are correct. That is the pattern of a 1, 2, 3. Higher low, higher high. This bar is bar 3. It breaks out above this height, and off we go. And in that theory, on any time frame, the price that really invalidates that is the swing low. So in that idea of a 1, 2, 3 entry, you don't even need to see where the RL10 is. Now, typically when we're tracking, we'll look at the RL10 and see, that's where the price really is. But on this one, the 1, 2, 3 happens so fast. I just say, look, as long as it stays above that swing low, I'm good to go. But if it were to fail below the swing low, I got to be out. So yes, your understanding of the pattern is correct. Questions on that? Okay. Next one. From your experience so far, the opening candle for an OR3 that occurs after a gap is often very large. Absolutely correct. Why? Well, because there was so much news and so much action and guys are surprised, it's triggering more people to get out than under no gap conditions. It's abnormal behavior. So that first 3 minutes can be frantic, clearing all of the market orders that are hitting because everybody's afraid of the gap. Or it could have been there were a bunch of orders in the book to sell at the open, and the guys looked at that and said, well, shit, well, that means we're going to buy it at the open. That means we want to drive the price way down so that we can get a better. So you got a lot of reasons why the bigger the gap, the larger the OR3. Absolutely true. Often larger than an R10 or an R5. Not unusual for that OR3. And you said, then you believe you heard me say, then I use the range of the opening candle as the MMRB. Sometimes, if it's that big though, Like if I'm trading EWZ or Alcoa, that I'm perfectly confident in trading because of thousands of iterations of that thing. If the if my R10 is 40 cents and the OR3 on that thing, let's say it gaps up here and then sells off and then closes here. And there's my OR3. And if that's $1 from here to here, and the price action looked like gap open, massive sell off, and close here, and then it starts, and then it opens here, and then starts going up. I look at that right away and I just say, there's the price that I'm going to get short on. Let me try that in red. There's the price I'm going to get short on if this thing were to fail, because that's my OR3 entry to the short side. Roger? But if my 40-cent typical management box, if I can hang that off the bottom here, and this thing opens and is now going up, I'll just go. I'll just go. If this thing has like, it could be two of those, that's pretty close, almost to scale. It's 2R to the top of the OR3. What if this thing doesn't, the mechanical entry on that OR3 would be here? Well, if I like it here, why do I like it here? Well, because if I came over to the low of the day and added a range stat, even if I waited this long to get my entry in, and if that whole thing was my risk, I still am going to have two of those probably to the top. Why? Because if this was the R10 and I add two more of those, then this is probably a frog box. So I don't mind getting in here, but I look at that and I just say, based on that price action, harsh sell, and then it didn't fail any further, and then it opened where it closes, and now it's starting to go up. I'll just buy it. There's going to be two things that happen. We already know this thing is in play. It's going to be a wild move. I'm not allowed to be surprised if it gets all the way back to here and I got 2R in hand. I guarantee you, if I get past 1R, I bet you I'm not losing money on that trade. I bet you that as soon as that thing gets up around 1R, I bet you I can move my stop to here for that bright shining moment. And now I don't have any risk in the trade. And if it gets to 2R, this is where I really start getting nervous. That's the 2R battle drill. What if it breaks out above the OR3? Then that's where I would have wanted to get long on an OR3 technique. And I know that even with a big, fat, wide stop like that, I got two of those to the upside. I got six from here. I've got six more of those to the upside. So I don't mind I could put a second position on if I was feeling froggy, or just manage my stop because it's the opening 30 minutes. The number that you care about on the things that you're specializing on is what is your, all things considered, your MMRB. What is the size of the box that you, in your heart of hearts, personally, feelings and everything, that you know you're not going to take more than a 1R loss? Here's four candidates for that number: the R10, the R5, the PSAR flip, and the OR3. I don't care which one you use. What I care about is for you to integrate that into some number about the thing that you specialize in. So, you know what? This week, it's 40 cents. For me, EWZ and 40 cents, It's been 40 cents for a couple years. You know why? Because I know what $400 per share divided by 40 cents is. It's 1,000 shares. Done.
So if you take the mechanical entry, if you wait for it to either break below the low or the high, if R10 is your number, are you just putting that as your stop? You're not using that full
Yeah,
dollar
yeah,
of the
yeah.
candle. You're just saying I'm putting that underneath where it
Yeah,
passed my entry
for
point and it's
me,
an R10.
yeah, for the
Okay.
things that I'm managing,
Okay.
for the things that I'm trading all the time. Like you don't see me scanning the Russell 2000 for some random stock that has hit my sniper pattern and then I'm just going to trade it. I mean, that's a technique. Like if I really like the SSC or something, but I'm not in, I'm too old for that. I like what I like. I like to go to a home game, and have home field advantage. And and so I've just decided that 40 cents for me, and every time I look at this, sometimes the OR3 is bigger than the R10. Sometimes it's smaller. Sometimes the PSAR flip is bigger than the OR3 and it's equal to the R10. Those numbers float around within 10 cents or 15 cents of each other. It just 40 cents feels correct to me for 1,000 shares. It's my number. And I'm not going to take more than a 1 hour loss on that thing.
Okay.
Hey,
Well,
so
that makes it a lot easier.
yeah, so what if on this 1, 2, 3, what if this was 80 cents? There's my 40 cents. And if this failed right away and broke through here, would I get out? Probably, because that thing's supposed to work. If that thing fell right to here, I'd be tempted to get out of that just because I have a hard time eating more than 40-cent loss per share on Brazil or Mexico just because I'm so used to that. It just feels horrible.
Okay.
But
So
if I decided I was going to go 80 cents, I'm not going to have, then I'm going to use a half a position because that's 500 shares. If I was going to take that wider stop than my usual thing, and I was going to tolerate twice my normal loss, I'm going to take half my usual size. Instead of 1,000 shares, I'm going to take 500 shares. And then what I'm going to do is my other 500 shares that I normally am putting on that thing, I got another 500 shares over here. If this thing starts working, I'm going to hurry up and jump it up to 1,000 because Brazil's working or Mexico's working, and I've only got 500 shares on it. What's wrong with me? I mean, that's what I want to put a normal workload on the donkey. The donkey wants to work.
if you did that where you increased it to 80 and you put on a half position, if you got a kata two after that moved up, you said
That
that
would
was
be a good reason. Yeah. Yeah.
would you base it on 40 again, or would you base it, you just
I
leave
would, when
the
I put the
shares?
second position on, like if this thing worked and I'm in a kata two, chances are this thing is going to be 40 cents because it's the pattern that the price is in that makes the difference. And if you had like on this one, this thing exited, but what if it didn't even go below? Let me expand that so you can see the. I get out here because of reasons. First reason, leg one, massive goodness. Look at the size of that move. Look at the time it took to make that move. There's a kata two. It only got that far and then rolled over right away. That's leg one. This is not a sign of strength. That is not a sign of strength. That's a sign of weakness. The move only lasted 1/3 of the time, or but leg one went that far. That was 1/4 of the size of the move, and it only lasted 1/4 of the time. That thing's done. So I get out. Hey, but what if that little thing that, like, hey, it's starting to work. I've got a rising Bollinger Band mean. As long as it stays north of the Bollinger Band mean, I like it. It's already well above the VWAP. I like it. How much more to the upside is there? I'd have to go back earlier in the day, find the low, add a range stat to it, then see if the upside move still has enough. It does. There's another dollar to the north of this thing. I'm very close to re-entering that thing. The only thing I don't like is that the leg two was so tiny that I'm really expecting this to fail, and the R30 agrees with me. Look where the R30 was from here to here. That whole thing is done. I'm not in a hurry to get right back into this thing. I've got 4R in hand. I'm good to go. Let me go take a look at the 30-minute bar. See, is there anything on that? There wasn't. It was stalling. So I might just give this another. Let me just take a break for 10 to 20 minutes and just let it develop. And then I would just say, let me pick some number. Hey, here's the peak of the R10, and there's the R10 peak. How about that's 2675. Let me give it up, something up in here. If it breaks north of here, then I'll go. And I'll put a 40-cent risk box on it. Done.
Now, if you do
Now
that,
let's say I didn't get out here. Let's say that this thing only came this far and then started going. And let's say that I only had the 500 shares on this, and I normally have 1,000, and this thing goes here. I'd probably be putting the second 500 on right there, to be honest. And that's a 1, 2, 3 entry right there for the Kata 2. The last thing that I saw was a really strong. Let's say that those two didn't happen. I saw a really strong leg one, and it's starting to work again. And here is a low, a higher low, a higher high. That is a 1, 2, 3 entry. That's a reasonable place to put a second position on. And if I had, maybe because of reasons, I only had 500 on here, that's a good reason to put another 500. The other good place to put the second position on was here. Why? Because I have 1, 2, and it broke north of this. So somewhere in that bar, I could have put a second position on a 500. Now I got my normal load of 1,000, and it rolls over, and I should probably be getting out around in here. But I only got half a position on, so I can muck around and be sloppy. So there's something to be said for knowing your number, having a standard number of shares, knowing what half of that is, you know?
So if you had exited after that first leg and then you were looking to get back in for the Kata 2 and you'd had your 500 shares, half of your position.
Yeah, so let's say I was here and I get out right here.
When you re-entered on the Kata 2, would you put 500 shares back on, or would you go ahead and put 1,000?
On this one right here, that's 1,000 shares for me.
So you'd go back to the full position with the tighter risk box. Okay.
You know, because here's why. Because my entry is right here. Call it 2675, you get filled. My 40-cent risk box is 26.35. Right?
Okay, right, okay.
I mean, and so, but where am I going to, if this fails, where am I going to get out?
You're gonna get out quickly.
Probably here, or certainly by here. So I can put 1,000 shares on there with my $400 of risk, but how much risk am I really taking? I'm only taking about that because there's the Bollinger Band mean. I'm really only taking 10 cents of price risk, which is going to be a 0.25, a minus 0.25 loss. And I've got 1, 2, 3R in hand from the last trade. So maybe I only had 500 shares. Agreed. So now I've made 3R and 500. I'm at plus 1,500. I can put 1,000 shares on here. I can risk $400 of this to put 1,000 shares, knowing that I'm going to execute at the Bollinger Band mean. So I'm only going to lose 10 cents on 1,000 shares. I'm really only risking 100 of that 400. So that's 0.25R. So I don't need any more. It's in fact, the whole point of the MMRB idea is that the closer you are to the execution fail, actually the less risk you have in that sense. Because it doesn't take much of a move. Hey, what if I got a 40-cent move? I'm really actually thinking I got away with one because I was only secretly risking 10 cents. Now, here's where guys will get into trouble and lose their goddamn mind. If I was risking 40 cents, I put 1,000 on. If I was risking 80 cents, I put 500 on. And I talk myself into, oh, I'm only risking 10 cents. So now let me put 4,000 shares on. Are you out of your mind? You're out of your mind if you do that. You cannot compare your performance on a 4,000 share position compared to a 500 share position. I mean, be serious. All you really need to think about is I trade this thing, small, normal, and large. And large, I'm going to trade it normal. And if I get more than 2R, I'll add a second position. And that's how I get to a large position size on the basis of evidence that it's working. But if for some reason it's too close, I can't believe it, pick your reasons. And let me just take half a size and be ready to put the second one on as soon as I get something like a confirmation. Right? How does that work out in practice? It calms you down. Let's say I only put half on, and let's say right in here I decide to put the other half on. All I really did was my average entry now is halfway up the stack. So it's as if I had put 1,000 shares on at the halfway point. That the same thing works on the exit. Like, hey, I got this amazing move, and it starts exiting. Hey, my aggressive exit is at the PSAR. My conservative exit would be at the Bollinger Band mean. Oh, woe is me. Which one should I take? Which one is the perfect? Let me go back and study 1,000 trades and see which one of these was theoretically the best against all of those 1,000 unique different trades. And then on the basis of that, I'll decide to use only this or only that. Why would you do that? Take one half here and one half here. And now you don't have to compute at all. If it comes here and you sell one half of your position there's two things that are going to happen. It's either going to come down and hit this, or you take your other 1/2 and your average exit is here, splitting the difference. You're happier than if you waited and took the full loss. You're sad compared to, oh, I know it. I knew I should have taken it all at this one because I knew it was going to come all the way back. You didn't know it was coming all the way back there. But that's what happens if the thing goes on to fail. Hey, but what if you exit half here and now it goes up and creates a new high? But you're only out a half, but you still have half a position on because that one didn't exit. Oh, then I'm happy that my conservative exit kept me in for half the trade. And all I got to do now is figure out where inside here I put the other half on that I got out here. Problem solved. All I got to do is re-enter with half a position, which is easier than re-entering an entire position. So the idea of splitting your position, half for an aggressive, half for a conservative, when the thing fails, you get the average exit. If it recovers, it makes your kata 2 easier, and you get to be right all the time for half a position. You're half right all the time. And you spend 0 time monkeying around with trying to come up with some magical rule from 1,000 different case studies, which all had their own unique circumstances anyway. So I don't even worry about that. I just say, look, I'm going to be satisfied if I take half here and then the rest here. But if it resumes, if this thing goes here and comes back and I take half, but instead of failing, it goes up, I'll just put half on again right here and I'm good to go. And if that happens, maybe this Bollinger Band mean is too low. Maybe I jump the whole thing up to here and then leave the Bollinger Band mean stop in play here until it comes up, and then I'll pick up the Bollinger Band mean again. So if that were the case, look what I can do. I can re-enter. Now I got a full position on right here. And my full stop is right here. And then half the position will act off of the PSAR, and then the other half will stay here until the Bollinger Band mean comes along and then picks it up and then starts moving at the rate of the Bollinger Band mean. Problem solved.
You said 40 cents, is that your position sizing?
It's my execution risk, it turns out. Actually, no, in this case, this one right here, that was at 37 and 20. My execution risk was only 10 cents, but my position sizing risk was 40. And I have every reason to believe that there's 80 cents available from 26.35 to 27.15.
Okay, so that when you say 40 cents, that's your position size. You
Position
size your
sizing
position
risk.
on that, and then you take your execution risk
risk.
is actually that's what you're drawing on your screen on your
Yeah.
nightly thing is your
Yeah.
execution risk, not your position size.
Correct. Because the
And then,
execution
but
go ahead.
because you said on your video that when you put a position on, you basically, from your psychology, you would say, I lost the execution risk. You
Right
put it
away.
on, the execution risk
Right
is
away.
lost.
Yep.
Okay. But I don't see you rarely accept all of the
Right. I don't
execution
even
risk.
like
That's just
that.
if you're
I
not
don't
paying
even like that.
attention.
No.
Yeah.
No. The
Sorry,
reason
no,
I
no,
don't
maybe
even,
you're on something else, right? And then
yeah,
just
because,
it's your
well, right here,
protection.
look at this. Look at this. If I get long here and I say, hey, there's my execution risk. And what if I get out here, you mean?
Yeah.
Yeah. You know what I just made? I feel as soon as I put it on, I lost 1R. I feel that. And I just
Like an
what a
execution risk.
yeah, yeah. I just, God damn, what an idiot. At least I didn't lose my position sizing risk.
Yeah.
But you know, when I take the loss right here, you know how I feel?
Better.
I made 0.5. Because I've already experienced this loss. That's a real feeling of loss, despair, disgust, self-loathing. I hate trading. But then I forgive myself. It's like, so I have felt the emotional loss of another 1R because, dummy, why didn't you just wait until this thing truly broke out and then you could be confident and then you'd feel relaxed and calm because you know that's going to work, because the payoff isn't as good. You get a payoff on the basis of how much heat you can take when it works. But there's a mathematical reason to believe that this can hold. But I still feel the 1R loss. And then if this exited right here and I took the like a PSAR exit and then I got a bad fill, so I end up selling right there, I feel like I got 0.5 back. Because I've already paid the loss of emotionally losing an R. Already paid that. Done. No double jeopardy here. This is America, the criminal justice system. English common law, no double jeopardy. Feel the pain once and you're done. You're a free man. So I just look at it and said, well, I got half of it back. I only lost half the execution risk. Joy. Guess how happy I feel when I can lock in no lose plus dinner for 2. If I could lock in, like plus 0.3, and like I can get my stop from here up to here, and now I've locked in that gain, that little 0.3 win, that's a 1.3 win. So there is some psychological tricks being played here. You know why? Because the guy that beats me up is the risk manager, the monkey mind in my gut. I have to trick him. I have to use the psychological realization that, yeah, I know you thought we were going to lose a whole banana and you felt like we had already lost the banana, but guess what? Against all odds, I got half a banana back. He's happy. He'd rather have half a banana than no banana, especially when he thought he had lost a banana. In my rational head, where there is cool logic and math, you think I don't know that this is mathematical magic and trickery? Yeah. It's child psychology. Yep, sure is. But I know that if I don't somehow accommodate those feelings that come out of my gut, the longer I ignore that, the more he's going to start getting nervous and he becomes ulcerous. And you're not paying attention to my feelings of risk. You're not listening to me, man. And he's going to interfere with me. That energy is going to leave this trade and go into the next trade or the next trade or the next trade. And that charge is going to keep building until I overreact the straw that breaks the camel's back. And for some reason, I find myself doing some irrational shit. Like being too large because I had a series of successful trades and I think I'm good and I don't have to use my standard tricks. I can trust that's danger for me. Every time I've been close to an existential loss was not because I was a desperate man gambling with one final throw of the dice. It's because I was too big for my britches and thought I actually knew something and I was smarter than the next guy. That's where I get into trouble. When I've had a bad streak or whatever, that's when I trade at my best because I am not going to lose. I am not going to get kicked out of this game. I am going to pay such close attention. I'm down to my last 3 bullets. I'm going to make 3 kills. No doubt in my mind when I put my mind to it and just get my mind right. So this whole series of psychological exercises between execution risk, which is geared towards the specific pattern that's in play on this trade right now. The execution risk is the adverse price action that tells me I must get out of that pattern because the hypothesis is over. And then the position sizing risk is going to be wider than that so that I don't put my portfolio at risk because of my rational conviction that that's the right number. And it prevents me from having wild variations in the maximum position size that I'm trying to squeeze. Guys that haven't had existential crisis in their life take a look at this and they just, well, I'm just going to do, and I don't disagree with that. We're going to see something here. We talk about optimizing pattern. If that's your game, knock yourself out. Take your risk. It's your game. But for me, no, I don't take a risk. I don't have to. And I can make my financial goals trading the way I trade at the size of risk that I can accept. And I can sustain good times, bad times, any season, any markets, either direction. Don't care. Trade the way you want to trade. I'm going to trade the way I trade. My point is that I know this about myself, the psychology, my heart that wants to do well because it's good for the team and we have visions into the future of what we're trying to achieve. And I know that I have skills in my hands to do things as a technician and a craftsman. And I know that I have the resilience in my feet to be able to walk 1,000 miles and take 1,000 trades. So I have resilience. It's this guy here in the middle that is the humble part of me that's always warning me, hey, you haven't seen the worst thing yet. There's new forms of hybrid tigers and sharks out there that you haven't seen yet. And you think that you can defend our perimeter, but you ain't seen those sharks yet. I haven't even seen them, but I feel they're out there. So I got to respect that and err on the side of safety. So that's what I want to say about that.
Can I ask you one more thing before you leave that?
Sure.
So your 40 cents, your position sizing risk, and your list of things that you're looking at, your regulars, there's going to be a different position sizing risk for each one.
Yeah, this
So
is,
you
it
could
turns
go-
out that EWW and EWZ, and I will tell Devon Energy is like 20 cents and Alcoa is like 10 cents just because that's the price. AI scares the crap out of me, and that's 40 cents.
So I can just go through on the 3-minute bars and use
The Dow is 10 cents. Those are the numbers, no matter what, I can trade
okay.
without sweating. I don't even have to think about, am I too large? Am I too, no, dude, that's the chip size.
And those
Okay.
are all position
Okay.
size risk.
Yeah, yeah.
Okay.
Yeah.
So I could go through my list for the 3-minute bars and just say that my R10 is my execution risk and decide what I want my position size risk to be relative to
Yeah.
that. So I've got a different standard for each name. And then it's real easy to adjust on the fly if you need to increase your execution risk or decrease it, just depending.
Yes, and the way I would back into that is I would start with the frame on the thing you're looking at and say, there is my no kidding execution risk. Let me just start with 3 times that or 5 times that. Take your pick. I mean, that's the idea behind risking $1 or trading 1 share live, just so that you get used to trading with live money. But if you just sort of defaulted to that, you'd never be so large that you'd ever blow up, because you wouldn't be tempted in the early days to exit in the noise, because even if you took the full 1 execution risk loss, it's really only 0.33 of a position sizing risk.
But you're not really exiting. You usually don't. It's rare that you take a full execution risk loss, I think, from what I've seen. You usually get
That's fair enough. That's fair, because
okay.
I don't worry about re-entering. I mean, like, if I got this one and it came back and I exited right at the Bollinger or right at the VWAP, and I could get right back in here and just say, well, of course. So what? Not even, well, I'm going to wait for a 1, 2, 3 entry after that and all that other shit. No, wrong. I was out too early again. Get back in. No
Okay.
harm, no foul.
Okay.
So but what about when it reverses on you right away? Do you wait the execution risk? Like when is the execution risk valid?
If it goes over half an execution risk, then I better pull the trigger now, because I'm probably going to get a bad fill.
Right. Yeah. Okay.
So I'm pulling the trigger in the yellow box, and I don't need
Yeah.
100% certainty, because otherwise, if
Right.
I wait for it to hit, then I'm probably going to get a bad fill. That would piss me off even more. But I would say, probably a half to 2/3, whatever I can get other than a full execution loss, I always feel like a moral victory.
So it's not that you won't exit in the noise, so to speak, or exit in your execution box. It's just by having that cushion, it makes it so it's not an emotional decision for you to.
Yeah, because we're only talking, if that's 10
You're doing
cents,
too early.
if that's 10 cents wide, you're only talking about 2 or 3 cents difference anyway. If I pull the trigger at halfway or all the way, we're only talking a few pennies anyhow. The main fact was that, hey, it's supposed to do this. It didn't. It's doing this. Ah, crap. It was too early again. That's the mindset. Good poker players muck 70% of their hands. They play the ante and they say, I'm not playing them. 70%. All right. Let me get to the other. Had some other questions to hit too. Yeah, this, if I was going to give a 1-sentence summary of all that, I'd probably say, yeah, standard position size all the time, so I don't have to calculate every trade. Just, I'm going to take 30 trades today. Just what's the size of my poker chip and what feels comfortable and normal, so that I don't have a tell, like being nervous. Like if I got nervous because I was trying to trade near my maximum allowable position size, I'd be a nervous wreck. Let's see, on calculate, let's see.
It'll help your span.
If I'm using if I'm using that standard position sizing risk, or execution risk or position sizing risk, it's easy because now, hey, if I had 40 cents, right? But on 3 different cases, based on where the PSAR box was and how big the flip was, maybe it's 0.3, 0.2, and 0.25. That doesn't even matter because whatever that gained, it gained 75 cents. 75 cents against a standard position sizing risk, easy. Now it doesn't matter what the different execution risk size was, as long as it was less than the position sizing risk. This gives me let's see, 1 7/8 R, which is 1.85, based off a common execution risk, or position sizing risk.
So you're not calculating the R based on the execution risk, you're calculating it based on the position sizing?
Yep. And and why is that smart? Well, that's smart because that is actually telling me how many shares I'm going to buy to have $400 of risk. So I know that no matter what the initial execution risk was, I think you got to think of this as an asymmetrical case study, right? If I'm getting long here and I have a successful trade, what I really care about is what was the dollars per share that I captured, right? I entered here, I sold there, I captured a certain number of dollars per share, my R capture. Hey, based on how big the PSAR flip box was and all that other crap, I'm still only going to gain, the 75 cents. But one time my execution risk was here, another time it was here, and another time it was there. But my position sizing risk for all of them was here, 40 cents. So now when I calculate the gain, dollar or 75 cents against the 40 cents, it didn't matter because I didn't lose any money on that trade. It doesn't matter what the initial risk was precisely. I can just round it off to 40 cents. And then I have then my 1.85 is actually a conservative R capture, check or hold.
Well, it looks like when you're looking at the charts, you're looking at the R based on the execution risk. But
Yes.
Are you differentiating what's technical based on the execution risk?
Yes. When I'm looking at the gross aggregate number, because if I got 30 trades in a day, that's not unusual. You know what I roll that all up into for intraday trading? All trades, net, divided by 400. Cash divided by 400. That's what the R capture for the day was. Net dollars. When I'm in the investigation stage and I'm just trading at a pilot level. See, what if I was doing in my pilot program, I'm only trading on a brand new system, I'm trading one share and it captured 75 cents. And what if I had a limited rate production, I was $25 a risk to see if it could scale. And so on this one, it's still in the scout and the prototype, I'm at 25 cents, or I'm sorry, $25, and I captured 75 cents per share. And what if I'm trading a system at 400 because it's production, and it captures 75 cents. If you let the position size determine the success on the trade, you're going to never be able to compare the quality of those three different systems. What you have to do is render it down into dollars per share of position sizing risk, in this case 40 cents, because I'm using that number to decide how many shares to trade at production. But if I don't lose money, then this is immaterial. What matters was how much did I capture per share positively, and then divide it by the standard denominator of my position sizing risk. So if I was trading Brazil and I had three, and I'm going to trade the COTA 2 each and every time, but in the morning, the PSAR box was that wide. And at lunchtime, because it was so narrow, it was only that wide. And then in the afternoon, it was that wide. It's all the COTA 2. And and each time they captured 75 cents of a move, and my position sizing risk was 40 cents. What's common to all of them was the assumption that 40 cents was the actual amount of position sizing risk I was going to take, not the difference, the small minor difference it's inside. But if you start calculating against that, it starts distorting your numbers when you have different levels of confidence in your systems. So all I do is I express things in terms of R. How much risk per share on to get me out versus R capture on a successful win. And then it doesn't matter if it was 1 share, 25 shares, or 1,000 shares. The R capture tells you about the quality of the signal. Now I can compare two completely different systems. Hey, on one of them, I'm going 40 cents and I'm going to trade $400. And then on a swing trade, I'm going to trade $400, but it's $3 of risk. Oh, so now I capture with 400 shares, I can only buy 133, or with $400, I can only buy 133 shares. But if the R capture was 5, I take 5 against 3, and that's a 1.67. But on a 40-cent risk intraday, if it captures 75 cents, then I had a 1.86 or 1.85. So in terms of R capture, this system is better than that system. Based on win rates and all that other stuff. Why? Because this one, I had to have a wide stop, $3, because of the unmanageable risk of overnight gaps. So I could only get within $3. So my position sizing was way low. And it takes 3 days to get that money. But maybe because it lasts 3 days and it's simple to manage, maybe I could have 30 different positions open overnight. Oh my God. Now talking myself into being a day trader. So now if I do that, now I have to start taking a look at the composition of the 30 open trades that I have and look for correlation coefficients and all that other stuff. Whereas on day trades, if I'm on the 3-minute, I got 1 or 2, maximum of 4 open positions and no overnight risk, and I can manage them all at the same time. And I can push a button and be out of all of them right now. So I'm going to let you chew on that one for a while.
Okay, yeah, I'm a little confused. I'll watch this again.
And then if you go into the recordings in the foundations, the Q&A sessions, and there's about 5 different discussions of execution risk versus position sizing risk. I've tried to explain this thing a dozen times over the last 5 years.
All you track is the
It's
bar based on
unbelievably
position size.
important. Psychologically, it is unbelievably important. The most important idea is that you have, if you want to standardize your position sizing risk, and let's say it's 40 cents for me in Mexico. What I'm doing is I'm trying to improve my entries and to see how close I can get the execution risk. If I use like a 1, 2, 3 entry, maybe I can get that down to 10 cents. If I use a 1, 2 entry, maybe I can get that down to 7 cents. If I use a WMB3, maybe it's 20 cents. If I use the PSAR flip box on 3 minutes, maybe it's 30 cents. If all of these different methods and techniques of getting in, if I take a look at this thing and I say there's a 40-cent position sizing box, it's because I know that there's an 80-cent gain reasonably available. And so on the scale of improvement, the 7-cent entry versus the 10-cent entry, if I was to position size off of that, that little 3-cent difference would make my position size 33% larger than if I was using 10 cents. But you and I both know that 3 cents in a $40 ETF is a hiccup. And so I'm not going to use that trivial difference to increase my overall position size by a factor of a third. All I'm going to look at it is say, look at, I'm going to base them all off a standard risk box of 40 cents. And then if I take the full execution risk, I'm not going to take a full position sizing risk loss. And then all that it really matters was that one entry was 3 cents earlier than the other one. But the R capture of 75 cents on one of them, you know, the entries were all the same. They all entered right here. One of them had 3 cents less of execution risk. But because the execution stop wasn't hit, the only number that matters is the 75-cent gain after the standard entry. And so so no matter which exit I used at the initial stop, the only thing that mattered was the exit that I used to get out. That is much more important than monkeying around with the initial stop for execution risk. I mean, to be honest, it's where you get all your math is how did this standard entry, which had a good enough risk box to keep me in the trade, and it captured these, when I used different exit strategies to get out of a winning trade, I might have had 4 different choices about where to get out. That's where the R capture is different. So you should be spending your time figuring out which one of those is a better long-term solution than trying to figure out how big to draw the initial risk when you don't know anything about that trade other than to say, I know that no matter what, I ain't taking more than a 40-cent loss. And so I don't really care where I draw that initial execution risk, as long as I know that I'm not taking more than a 1R position sizing loss.
So
Now instead of screwing around here, I can use a standard position size, and then I can put all of my effort into figuring out what the exit strategy for a winning trade should be.
So
because that affects your R capture.
that's what's going to be that's what's going to be stable. By decreasing your execution, those little changes that you make, you're going to see that reflected in your distribution as you have less
Yes.
less on the downside.
Yeah.
But where it goes and how you exit it later, that's standard.
Yeah, so now I
what-
want you to think about your focus, your locus of control. What are you focusing on? Trying to fine tune how big the irrelevant execution risk was, or the position sizing differences between this entry or that entry or these. No, you just pick a really wide one, 40 cents. And I know the other ones are all going to be between 7 and 20 cents, depending on where I draw the line to execute. And I just have a deliberately wide stop that covers them all. Done. My position size is going to be smaller than mathematically allowable because I'm using a wide position sizing stop, but I'm using a smaller execution stop to get out if it fails. And then I'm only taking that's going to be measured in minutes. In a couple minutes, hopefully, if I got a compound critical state and this thing is working, it doesn't matter where that first stop was, because as soon as I get a certain distance up, I'm going to move it from wherever it was to no lose plus dinner for two. And now it's moot. It doesn't matter where it was, because the only thing that matters is I've got a winning trade already. Do you see how that is more important than trying to
I
monkey
see what
around
you're
with the?
saying. Yeah, I see what you're saying now, because that's what makes your entries not important. And that's what
Yes.
makes that you're cutting your losses, and your profit's going to be what it is based on your standard. But that's what makes the entries not important. And again, I'm repeating myself. But
Yes, exactly right.
get it. Okay.
What I'm trying to do is I'm trying to, in that compound critical state, my theory is this thing is poised because of reasons, and you've heard them all. Because of reasons, I am entitled to believe that that thing could move hard, at least twice as big as this enormously wide position sizing risk of 40 cents that I'm going to take, or whatever the number is for that symbol. And then I can decide that compound critical state, which I can measure in a couple different ways. If it was the PSAR flip box, maybe the line is here. And if it's the RLFF, it's there. And if it's whatever. So I got all of these other little choices that, depending on the indicator that I'm using, they all tend to fall around in that little area. But I have a buffer of a very wide position sizing stop. And then no matter what, if that thing starts working right away and it gets just a couple bars out and it's going, then my execution risk, wherever I drew it, is going to get moved up north of the entry anyhow. So I'm locking in gains, our capture per share, and I'm going to measure how much I gained from my entry against this giant risk box of the position sizing risk. And the giant position sizing risk of 40 cents, I used to calibrate to say, yeah, there's 80 cents of reasonable upside gain. So what I'm really trying to do is minimize the amount of time that I have seed capital at risk. That's my money at risk in here. But if in this elapsed time from here to there, I can get to no lose plus dinner for two, I no longer have seed capital at risk. The worst thing that happens is I make $100 that I didn't have before. And then the only thing that matters is And I don't know how far it's going to go. I know that 80 cents was not unreasonable, but it could go any distance up there. And then my decision is, how far do I let it come back before I start locking in the gains? Do I cut it there or here or here, or do I let it come all the way back to the no lose plus dinner for two? What was the maximum favorable move? And then so if I'm going to study anything, it's how much time did it take me to get to no lose plus dinner for two? It's on the clock. And then once the RL10 rolls over for me, when the RL10 rolls over, you see me raise my stop to the edge of the dragon right away. Because I feel like I've seen leg one. And so many times leg one was the biggest move. So if I get out pretty quick, but it reverses back in my favor, I can get back in pretty quick with a kata two. And there's my little execution risk one more time. But the sooner I get out, the more of the move up I'm preserving. And I don't care how far it comes down after I've exited and it starts to recover. It's always going to be a kata two until it breaks below the lower low of the very first trade, where the first trade's risk line was, because that's where the PSAR flipped. So I don't care where it reverses after I've exited. No matter where it exits in here or reverses in here, it's always another kata two opportunity. All right. Enough on that. So I calculate, I should say, I'm sorry, that should read position sizing risk. I calculate off the P risk. Typo. Let's see. Still unclear as to how to decide whether to do a gap and go or OR. It's feeling. Gap and go if I feel that there's urgency in the price action. What do I mean? What could lead to feelings of urgency? It was a big gap or it's a fast mover. The space between the trades is large. It's moving now. It's being traded at larger than normal size. Or it's stronger than all of the other symbols in its sector, or the market is really unusually strong, or the whole sector is strong, or maybe yesterday it was at a trade location in the 10-day range that makes it prone to those big explosive moves. So I'm looking for reasons to describe a feeling of urgency that it's just going to go. And I can't make a rule out of all those that are definitive, because if I were to list all of the factors that it could be, you would ask me what the relative weighting of each one of those in relative importance. And there's a range of all those. So fuck it. It feels like it's going. I go. It's got to be bigger than my wrist box, my normal usual feeling of the wrist box. If it's already moved that, fucking go. That's why I like to do the bracket of the RL10 right from the open. If it's a big gapper and I slap it on there and it breaks out, I'll take that in the first minute. Now, it is also true that what you said, that the OR3s after a big gap tend to be bigger because all the news that it has to process. And the OR3, when it's small, typically had price actions in the first 3 minutes where it's backing and filling and it's finishing in the middle of the range. What would that look like on a 1 minute bar? Could you plan to trade on a 3 minute bar, but look at 1 minute bars? Yes, you could, because it's going to open here. And what if the first bar looks like this, and then the second bar looks like that, and the third bar looks like that? You know what that looks like on a 3 minute bar? It looks like this. What if the opening bar was this, and then the second bar was like this, and the third bar was like that? That bar looks like this. Open, close. that is not a runaway move. That looks like an OR3 like this that I'm happy to get long here or maybe short there. But on this one, when you see this in that first minute, it's going, dude, go. Especially if this was one of my little 40 centers and that was already 40 cents, go. If it's moved a position sizing, and the upper limit of that is a frog box. That's what the frog system was. From the open on the leapfrog, if it moved a full frog box from the open, you just, no matter how long it took, you just went. It was the distance, not the time. And then over time, what we've been able to do is reduce that down to like an R10 or an R5. 1/3 of a frog box, 2/3, 3/3. So you could, that opening bracket of an R10 on either side of the opening is a way to do that. All right, let me, I'll cover this on Sunday. No, I can do this quick. This was on optimizing parameters. So one of the reasons we got the 5DD was because Larry Connor's work said, hey, 3 days down in a row out to 5 days down in a row was a pretty good idea. So we went and tested every symbol in the Dow and the S&P 500 and the ETFs. And we said, what if it was down for 1 day and you bought it and you held it for 1 day? And we studied that for a 30-year window. What if you bought it? What if it was down for 1 day and you just automatically bought it and held it for 2 days, 3 days, and all the way down to 10 days down? And what if you just mechanically held it for 1 day and you sold it after 2 days, 3 days, 4 days? This is where the local heat map showed a temporary improvement that between 3 days and 6 days down, that if you held it for 4 or 5 days, you got the best payoffs. And that if you were on either side of that, it was still better than, this was all noise and just, there was no statistically significant difference. But it turns out that once it's down 3 days and as many as 6, there was a sweet spot for a turnaround, and that turnaround would take anywhere from 3 to 6 days to get it back. So it's like it's monkeying around right here, and then for some reason it sells off for 3 to 5 days in a row, and then that quite often is the anomaly. And then guys are going to come in and say, well, that's unusual behavior, and they buy it, and it takes the same amount of time to get back to the previous fair value. So that is a form of parameter optimization as described in this book. Pardo's book is brilliant. Everything he wrote was brilliant. And all we do is just simplify it and make it as primitive as possible. So I can measure with a micrometer by knowing where the edge is, and then mark it with a crayon and cut it with an axe in practice. In practice, I want to keep it simple, standard work for position sizing and exit, so that I don't have to think about it, so I can trade like a battle drill and just get a lot of repetitions. The 5DD research is like that. Going back to have one standard entry and then checking 4 different exit strategies off the same winning trade, and then comparing the statistics over hundreds of standard trades will tell you something about which is a better exit for you. You can study the performance. That's the parameter that you want to test. Hamad asked, when I'm looking at historical trades and studying things, what am I looking at? Yeah, these are all things that we look at as indicators for tomorrow. And in terms of looking at quality of execution, I really look at the performance of the overall strategy on the control charts that you see with the production line, the histogram, the win rate, loss rate, average wins and losses. I'm looking on the daily AAR on each trade that I take. Was I following proper procedures on the techniques that I use? When I look at the trades that I took, did I spill? In other words, did I give back too much? Or was I missing opportunities? Are there moves happening that I am not even seeing or I don't have rules for? Where do I have feelings of regret that it somehow my inner monkey tells me I should be able to do better on getting out sooner or preserving more of the win? Are there things as I look at the standard markups that show me better ways to improve my standard exit management? I'll do a separate lesson on Sunday about, for swing trades specifically, the trade index analysis. There's a lesson on that in the foundations. It's gold. If you're going to be a swing trader, that briefing is gold. I take a look at, from wherever my entry was, where was the maximum excursion, and then where was my exit? Did I exit before the maximum excursion? Did I wait till after to see it? And then how much did I give back or how much did I miss? That's what this trade index analysis will do it. I also am interested in looking at my entries and exits and comparing it back to the seasons of the MACD and the slope statistics of the regression lines to see if my execution is in accordance with those simplifying models. And I look to see where am I buying and selling in terms of proximity to the PSAR flip boxes, because I really believe that is the cornerstone of the change of trend from one direction to the other. This is a note from Jeff and Sonal at our factory, ourfactory.io. Sonal is hanging out her shingle to do a form of hypnotherapy for traders that is anchored into your practice. And she has 20 years of experience and is now a licensed hypnotherapist in the UK. And this promises to be very, very exciting. I've taken a couple sample sessions with her. This is a really good description of what she does. Absolutely trust her and Jeff with my life. And I was prompted by the work she did with me to start my own certification in hypnotherapy to become licensed to do it myself, because I have a very strong belief in its efficacy based on evidence. So that's what I wanted to say for tonight. We'll get this published and posted. And if you're in the sound of my voice, we'll start the daily in about 15 minutes.